Really, the idea is to shift your mind from thinking, okay, there's nothing you can do, my tax is what it is, to how can we make this deductible?
Okay.
How can we make this legal, right? And the idea is to back it up by money, by purpose, by paper trail, and everything else.
When you need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.
Hey, this is Bruce Weinstein. I am your host of Ask the Planman, and I am being joined today by Tatiana Tzior. She's a CPA. She's an MBA. She is, I don't know what this is. You'll tell us. USTCP, United States. I don't know, something. You'll tell us. It's an award-winning accountant and business turnaround advisor. She's got over 20 years of experience helping visionaries build their businesses and change the lives that they're trying to make for themselves. People hire Tatiana to uncover hidden revenue, build resilient systems, significantly increase their profits, and all this time paying taxes legally. How about that as a concept, paying legal taxes? We want to avoid taxes. So you've seen her in Forbes and Fortune and U.S. News and World Report. Tatiana is a frequent speaker at conferences and brings fun back into business and taxes. She's the author of Dream Bold, Start Smart, Be Your Own Boss, and Make Money Doing What You Love. Oh, so Tatiana, welcome to Ask the Planman. I was teeing it up for you. We want to share with everybody what kind of strategies can we be giving people to put in place before the clock strikes midnight on December 31st. I had a call the other day. A client's like, can I fund this? Can I fund that? I'm like, no, that had to be done last year. Even though you're on extension, there's certain things, those tax deductions and opportunities, a lot of times everybody has to be done during the calendar year. So Tatiana wanted to join us today. Tell us what's going on.
So a couple of things, actually. So the USTCP stands for United States Tax Court Practitioner. It's a non-attorney counsel in the U.S. Tax Court, which there are 9 districts of, meaning it sits in 9 districts for calendar calls. And the reason I got the certification, only about 300 preparers, accountants have that certification. I mean, unless they're an attorney, then they wouldn't need it. Is because I wanted to learn the rules of evidence. I wanted to understand the procedure in tax court. I wanted to make sure that when we do proactive tax planning for our clients, that I can actually take a position, because according to standards of tax practice set by American Institute of Certified Public Accountants, we cannot take frivolous tax positions. We cannot take tax positions that have very little chance of being sustained. And so they're actually called frivolous tax positions. So when I sat for the exam, it took about 4 years to get the license. Shouldn't have gone to law school at that point.
You could have been done faster.
Yeah, exactly. But my goal was to, as we do tax planning throughout the year, because taxes is not a once a year event.
All right.
And certainly if you want to pay less legally, it's something that is not done during tax season. During tax season, nobody has the time to do much of tax planning for you. The idea is to proactively save tax. And as we work through with you on that, we also create the paper trail and money trail, so that if you ever have to get audited and defend your position, if the auditor is being stubborn, sometimes they don't have enough educational knowledge. They don't have enough knowledge to say, oh, like this is correct or this is not. Then sometimes you have to go to tax court. Usually 90% of cases, actually probably more than 90, are settled out of court. And usually once you get in, the court representative, the clerk will generally, and the district attorney or actually the commissioner's attorney would settle with you simply because they know the law and the rules, whereas IRS agents don't always do. They do know a lot, but depending on who you get or whom you get, you might not win. Let's put it this way. So the idea was for me to do that so that we establish contemporaneous records and money trail to support every strategy that we have, so that we're not just talking out of our ASS, but we are actually
That's
making
another
stuff
acronym,
happen.
everybody.
Yeah, so we can defend you, so that we can be confident that you
No, the
will
onus
win.
the onus is on us. If God forbid you got audited, you better have your record. So it certainly makes sense what you're saying. Keeping a trail, having a trail, especially today's technology era. We have it's so easy to put stuff on your app and track your mileage and keep track of your receipts and things, and the Quicken and the QuickBooks and all that stuff. Like everything's right there. Like it just downloads. It's the days of manual entry and putting in 17,000 things manually, fortunately, have somewhat dissipated. But so when you and I spoke last week about having you on the show, we wanted to give people a sense. I don't mean to cut you off. Did you finish kind of explaining some of that? I was kind of segueing, but
I was actually going to segue into something very specific where I can actually show you why I got the certification, why it matters. So one of the things that we do is actually, we do this for every client who works from home. So most clients post-COVID do some work from home. And now we're talking about people who have their own business. When you work for someone else, if you work for someone else on a W-2 and you don't have a real estate portfolio or investments or a business, there's really nothing we can do for you. So we really don't take on clients like that. But when you have a business, because U.S. tax code so far has been geared toward businesses, U.S. businesses, there is a lot that we can do. And so for many people who do some work from home, we do something called the Augusta rule. The Augusta was, it was a tax court case, which basically allowed you to rent a living room in your home from yourself and your spouse. Let's say if you own the home jointly, up to 14 days a year. The rent gets deducted from the business and it gets not included in your personal income because it's under 14 days or under. And so there are certain things. It has to be legit. It has to look legit, right? So that's why we talk about the paper trail and money trail. There should be transfers for rent. There should be market rent. So how much would a conference room cost around you where you are? Maybe, let's say I'm in the suburbs of New York City, maybe in New York City to have a conference room for a day, to do some business planning, to work on your business, not in your business. So that's kind of what we do there. We do that assessment and we set up the leases and all kinds of things like that. And then you have the board of directors minutes, because if you do own a corporation, for example, you're required to keep minutes of board meetings every year. That's part of your compliance. So, I mean, this Augusta rule is not just available to corporations, it's available to partnerships and single member LLCs and whatnot. But the idea is that it has to be legit. You can't just pretend, oh yeah, I'm having a meeting with myself, which is, sometimes you can.
My dog came in the bathroom with me and I called a meeting to order. No, that doesn't count.
Pretty much.
Listen, I have a lot of OnlyFans people out there. So, how do the people that have OnlyFans, like that's year round, that's more than 14 days. So that's more home. That's a different rule. That's a home office deduction or something like that. Is that similar?
It's a different one, and you could have both, and you could deduct both. Because think about it this way. I have a pretty significant property, a house that's significant, right? I have one room where it's my office. I sit there every day, so that's designated business space. Yeah, like you. Okay. Yep. And then you're renting a living room 14 days a year. So for 14 days a year, it could be one a month. And then you have two, let's say year-end and mid-year planning sessions. And again, you could be calling a coach. You could be having it with your family and they help you brainstorm. We do that all the time. But the idea is that you actually use that space to work on your business. And so
let me, so even though I have a home office downstairs, I can take an additional expense deduction for using a different room or part of my house for something specifically carved out under these rules or guidelines. So it's an additional expense. So it's the percentage of this room. And then, okay, we're going to have our monthly board of directors meeting minutes, whatever. Or I have a business coach session or something like that, but outside of this space in a different space.
Correct.
Okay. That's good to know. And that's called the Augusta rule.
Augusta, yeah. It's AUGUSTA. It was a court case in tax court. So
that's a good golf course. Awesome. My listener will remember it that way. You tell them it's golf. Oh yeah, Augusta. Okay.
Yeah. So one time
I have to feed these people. You know, you got to give them nuggets. They can. Oh, okay. I'll remember that.
I understand. I understand. So a couple of years ago, a client of mine, and the newer generation of clients, they're a little bit more like, what else can we do? What else can we, what can we do? What can we see? And so they look a lot on forums and Facebook groups. And so he sends me a screenshot of a Facebook group post where for real estate brokers, agents, he happens to be one, the client. And the screenshot says, "Hey guys, just wanted to share, my accountant has been doing this thing for me, the Augusta rule. I'm deducting $75,000 for the year, tax-free. Like, this is insane. If you want introductions, I can do this for you." And so I'm looking at this, and people buy it. Like, people, it's, they buy into that. And it's just, to me, it's very interesting, because if I am looking at it objectively, I mean, put yourself in an IRS agent's shoes. Why in the world, or how in the world would you pay $5,000 for a day of a conference room, like a small conference room for your business planning for a couple of people? Like, would you pay $5,000? Like, you could never support that. Yeah. You could never prove to the agent that that's market rent. And so then you're charged, if and when you're audited, you will be charged disallowed big portion of that expense, and penalties and additional tax and things like that. But imagine they audit you for 1 year, because they typically don't audit you today for 2023. They would audit you today for 2020 or 2021, whatever that year is.
3 years back, right? 3 years?
Well, 3 years, but 3 years from the due date of the return, or actually filed date, whichever one is earlier. So let's say, the 2022 return, 2023 return was due April 15th. Let's say 3 years back they can go.
Well, the key is, as you're saying this, is once you open up the can of worms, because where there's smoke, there's fire. So if they're going to challenge you on the current one, now they're going to go back as far as they're allowed to say, let's see what else this knucklehead's been trying to get away with. And you just opened up Pandora's box, right? And folks, just so, Tatiana, you'll confirm this. The difference between tax avoidance and tax evasion is 15 years. All right, go ahead, keep going.
I don't know if it's 15 or more, but it's definitely some years.
I've been telling that joke for 38 years.
Okay. I actually know a tax attorney who went to prison. Yeah. What I find interesting is that attorneys often are the ones who break the rules because they think they can get away with it. They get too confident in serving clients, and honestly, really damage our reputation as well, which is okay, because we're different.
Attorneys damage their own reputation.
Yeah, but this is just to explain kind of the reason why I got to the USTCP, so that I can make a judgment call of, can I actually defend this in tax court? Can I, with a straight face, say to the agent or the prosecutor for the service, for the Internal Revenue Service, can I actually tell them that this is market rent, that this is legit? Can actually prove that, because the burden of proof in that case is on you. So you better know what you're doing. And it's nice to pay a lot less tax, but like I said to my client was like, "Oh, this guy doesn't pay payroll taxes and he went to prison for 6 months." I'm like, "Do you want to go to prison for 6 months?" I mean, if you do, then it's a different conversation. Maybe I'm not the right accountant for you, but
yeah. I'm sorry. Did you represent Mr. Capone? I'm not sure that's who I want working for me. So we got the Augusta rule. Now, are some of these tips going to be more towards the business owner, you think, or something that pretty much even just American, consumer, customer, tax filer? Like, do we have some basic things people want to make sure they're doing by year end, as well as a business owner?
So, I mentioned this in the beginning, and I said that generally speaking, if you just work for somebody else on a W-2 and have no real estate, no investments, no plans to have real estate or investments or business, then like we don't work with clients like that because the US tax code is geared towards small business, which means that really there's nothing we can do for you and there's nothing a tax planner can do for you if you don't have a business. So most of these are for those who have a side hustle, a business, real estate portfolio, maybe a couple of Airbnbs and things like that. So when you actively manage a number of properties, there could be rules that would allow you to deduct a few more things that normally people who have real estate investments wouldn't be able to. But I'm not going to go into that much detail with that, but I'd rather provide you with a couple of ideas. And really the idea is to shift your mind from thinking, okay, there's nothing you can do, my tax is what it is, to how can we make this deductible?
Okay.
How can we make this legal, right? And the idea is to back it up by money, by purpose, by paper trail, and everything else. So Augusta is one of my favorites. We do this for pretty much every client because every client does work on their business, whether it's a side hustle or a business that's, brick and mortar. We also do something called an accountable plan, which I think is useful for the listeners and viewers. Accountable plan is something we do to reimburse the business owner for certain things. And I'll give you a few examples. So unless you're leasing a car, and it's 100% business, which, for real estate professionals, absolutely. Most of the time is 100% business, maybe 99.9% business, but because they live and breathe real estate. But for certain businesses, it certainly is. If you register a car under a personal name and you don't lease it, it shouldn't be booked in your business. A lot of preparers don't know how to handle that. Book it under your business. And then as soon as you get audited, the first question you're asked is, show me your asset list. And so you'll have to explain that your car is used a portion of the time for the business. And it's not worth the hassle and it's not worth being red flag for an audit. So lease a car for the business or use an accountable plan. So an accountable plan is a piece of paper. It's basically a written plan that allows you to do quite a few things. So reimburse yourself for the car. So you can legitimately 4 times a year, some people do it every month, reimburse yourself for, let's say, mileage that you've driven for business. Oftentimes, especially if you own a car and it's your personal car, mileage will provide a higher deduction for you, especially for electric vehicles. And the reason is the electric vehicles don't have gas and the mileage rate includes gas. So there is a win-win there. Then you also can reimburse yourself for a couple of other things, like phone. If you have a personal phone that you use for business, then you can reimburse yourself for up to 80% of the phone cost using an accountable plan. Now, and the most important part of the accountable plan is reimbursing yourself for the home. So you have a home office. Normally, if you are doing this right, you should be deducting a portion of that office. Now, deducting as depreciation, right? The problem with that is that normally when a married couple sells a home, after holding it for a number of years, they can exclude up to $500,000 worth of gain. So what they've made on it, you bought the house for $250,000, sold it for $750,000, made $500,000. That's it. Like you're good. You're not paying any tax.
Can I stop you just for a second? I want to elaborate on that since you brought it up, because I just had this conversation with a new client that is selling his home after 30 years and was discussing with me rolling it into the next house. And I'm like, no, bro, like that changed years ago.
Yes.
So a lot of people don't know about that change. So let me just expand on it for a second. So hold your thought. So what Tatiana is saying is if you own your home, it used to be for many years your primary residence. You wouldn't pay taxes on your capital gains. When you sold it, it would roll into, and you had a certain amount of time to roll into the next property. So it was almost an unlimited amount of tax savings and continued deferral. And I don't know how long ago it's been. It's got to be 15, 20 years because my father and not quite stepmother never got married. got married to take advantage of the tax credit when they were selling their house that had a pretty low basis. So they knew the rule. And so they went out and got married so she could get the extra $250,000 protection. So folks, a married couple, or individuals, $250,000 is the limit on the capital gain exemption or exclusion. So with COVID down here in South Florida, home values doubled and some even tripled. So if you paid $400,000 for a house and it's now worth $2 million, you're going to have over $1 million of capital gain exposure. You cannot protect it anymore. It doesn't roll over to, go buy another $2 million house. So I want to make sure people heard that and understand it because, like I said, I got a guy 70 years of age. And he's like, yeah, I'll just roll over my next house. I'm like, no, it doesn't work that way anymore. So go ahead. So pick up where you were saying. I apologize, but
No, it's good.
You gave me a nugget. I had to swing.
So when you sell that home, if you have depreciated it for your home office, and if you haven't depreciated it, you are still treated as if you've depreciated it because the depreciation is allowed or allowable. So let's say you use 10% of your home for your home office. You are supposed to depreciate let's say 10% of $500,000 that you bought it for. You're supposed to depreciate it over 27 and a half, 39 years. So whether you do or don't, you actually are treated as if you did. And so,
wow.
And so that's a problem because when you sell that home, and it happens all the time. So 31 million businesses in the US, 25 of them are sole proprietorships / single member LLCs. So this is very relevant to those.
25 million of them, not just 25.
25
of the 31. Yeah, not 25.
So you're treated, if you own a home, if you rent, it's different. But if you own a home, you're treated as if you depreciated that 10%, let's say. And then when you sell, the exclusion doesn't apply to the 10% and the depreciation is actually recaptured. So you get taxed on that depreciation that you've taken or should have taken, and you pay additional tax on that.
So even if you didn't take it, you're going to get flamboozled. Oh, you got to love the rubber band effect. Wow.
Yep. So the idea is with an accountable plan for certain entities, not for sole proprietorships that don't have any sort of entity protection, but for those who have entity protections, especially S corporations, C corporations, partnerships, those who are formally registered, you can have an accountable plan where you can reimburse yourself for a portion of your mortgage interest, landscaping, property taxes, insurance, all of those things that are generally not deductible. For us, for humans, for individuals, only interest and property taxes are deductible on the home. But when you get that as part of your home office, you can take all of the expenses from your home as long as you have the receipts and reimburse yourself on a quarterly basis, monthly basis from your business. So basically, that's an untapped opportunity. A lot of people miss out on that, and you don't have to depreciate your house, which is awesome because then you can just claim the full exclusion. So that's very cool. We do that again for almost every client. Every client who works from office or does any sort of work from home office, we do that. One thing I wanted to mention that is not related to the sort of the official tips for the year-end tax savings, but something that you should know. As I mentioned, 25 million businesses in the US are sole proprietorships. Probably most of them, I would say, are single member LLCs. Now, think about it this way. When you have an entity tax return, it's a separate tax return. You have to pay for it separately. You have to have the books for it and stuff like that. So it's a little bit more expensive, but the audit rates, as of a few years ago, I looked up the audit rates. Audit rates for entities were 0.34%. The audit rates for Schedule Cs, which is what this is, single member LLCs, was 3.4%. So a 10 times higher audit rate for Schedule Cs. It doesn't mean that all of those Schedule Cs have to be S Corp. Some of them may benefit from being a C Corp or a partnership. That structuring is actually one of the things that we do and we love doing and we're great at. Because we are looking at, okay, how can we squeeze the most amount of tax with the right structure? But keep that in mind, that the audit rates for single member LLCs, Schedule C filing, when your business is a part of your personal tax return, are 10 times higher. And rightfully so. People cheat on their taxes all the time.
I'm not saying that. I'm pleading the fifth. I'm not saying that.
Well, but we bend the truth a little bit, right? I mean, it's all about tax law is never black and white. It's always primarily gray. And so there are certain things where you can take a certain position and bend it a little bit one way or the other. The idea is to have law on your side and make it legally deductible. So that's kind of what we do every day.
Yeah.
We help people
Well,
do that.
I think a lot of people don't realize what is and what isn't in the general purposes. And then they get involved in setting up their own business. And then it's like, well, I couldn't do any of that on my personal side. And they don't realize, I mean, like we tell clients all the time, do you own your own business? Yes. Like, well, we're enrolling you in health insurance. So that talk to your tax advisor, but that should be something you put through your business. You're allowed to provide health insurance, and it could and should be a tax deductible item. So, you know, I'm surprised we guide people frequently because they just don't know or aren't aware that that's something that they're entitled to take. So it's like, you know, we ask for the payment method. I'm like, well, do you have a business? Yeah. Well, pay it through your business account. Like you have a business credit card or a business checking account, like run it through there.
Can I be a devil's advocate for a second?
Yeah, please. Go ahead. Oh, am I in trouble?
Well, it depends. So for S corporations, I wouldn't recommend that. I wouldn't recommend running it through your business, especially if you have other people working for you. But I wouldn't recommend that if you're a single member LLC partnership, whatever, absolutely do that. But if you're an S Corp, the rule of the S Corporation is that medical premiums paid on behalf of the owner, 5% or more, have to be includable in the W-2 Box 1 income. So very few accountants know how to set this up right in payroll to make it right. So basically, think about it this way. Your Box 1 is your normal wages, and you can reduce that by your deferrals to a 401k, pension, you know, whatever. That same box gets increased for the premiums paid on your behalf or by the company. But if you don't, if you pay it personally, you could still deduct it for AGI. So you could still deduct it as a self-employed insurance. You just don't run it through your business.
I'm going to pretend I know what you're talking about. Discuss it with your tax advisor. So again, I'm going to say discuss it with your tax advisor because I always get confused with the LLC and the sole proprietor stuff. I passed that part of the exam on my CFP many years ago, but I never really understood it all. So the point is, if you have your own business, because you said W-2, so now I don't take a W-2. We're Schedule C. Everything flows through, and based on this conversation, I got a 10 times greater chance of getting audited now being a Schedule C. So I'm not going to sleep any better tonight knowing that information. But the point is, folks, if you're listening here, I'm having some fun with Tatiana, but you know, in all seriousness, you want to talk to your tax professional. I'm not a tax professional. I do insurance and planning and, you know, that type of work. But I've been doing this so long, I know certain things that are advisable to be considered, you know, for tax purposes, an expense allowance. So if I work for John, you know, pick a company, AT&T, and they offer me health insurance, it comes out pre-tax. I'm a W-2 employee, and it goes through my payroll deduction, right? So if I have my own business, I'm allowed to have that same consideration. However, I'm paying for it and the infrastructure of it and the sole proprietor, single member, LLC, S Corp, you know, Schedule C, like that's just alphabet soup for me. But your tax person's going to guide you. Tatiana's going to guide you there. I opened up my mouth, but I want to be very clear. In all seriousness, you want to seek your tax professional, right? So, because half the time, if not most of the time, I don't know how the client's business is structured, you know, for me telling them that. So I'm going by what I know because we're Schedule C and ours is picked up as an expense. It's a deduction. So I'm under that same premise, but maybe that client isn't structured the same way. So I need to be careful. So thank you very much for that.
Actually, even your deduction is not picked up on the Schedule C. It's picked up on Schedule 1, which then adjusts your gross income. So
My income is gross. Yes, you're right. My income is very gross. It's got to do better. I'm in a lot of trouble here. I should not have had a tax conversation. Even the election, I've already been drinking since noon. No, I have not. This is water. It's water. It's water.
I
Relax,
would be
everybody.
drinking. I would be drinking.
Yeah.
Probably going to drink after this.
Anyway. All right. What else we got? Oh,
Great.
finally I got a like. Somebody liked us. All right. Thank you, liker.
Great. So a couple of things that are pretty simple that you should just keep in mind. Obviously, if you wanted to clean out some old stuff, old junk, donate it, do it before the year is over. This restructuring, the changing of the entity, like if you have a single member LLC, you have some options. It could be a few different things. Generally speaking, I don't switch single member LLCs to S Corps past November. So end of November is already a little bit kind of pushing it. I've done it before in February. We haven't heard from the IRS for, 6 months. So we had to extend just to make sure that they've gotten it and they've approved it. So I don't like to do that. I don't like to have that drama hanging over me. So we typically do this by the end of November. And there are rules and procedures that you can restructure for this year before the end of November. So there are some things you can do. And generally speaking, as a rule of thumb, if you have a business, you can save money on tax if your business makes $75,000 plus in net profit. Because then the savings on your taxes outweigh the extra costs of filing the tax returns and then some. So that's the idea. So a couple of these little things. The commingling of funds is a big deal. The first question you're asked on an audit is does the owner pay personal stuff from business? First question on their questionnaire. And if the answer to that is yes, and if you should be honest, then they will probe a little bit more cautiously, meaning they will presume personal unless proven business. So you have a much higher burden of proof if you do that. So if you need money from your business, direct transfer business to personal and then pay all of your personal stuff. I have an elderly client whose bookkeeper pays personal stuff, and he was audited. His business was audited, and I came to the auditor and I was like, "Yeah, he pays. They pay personal. He's 73, so like he pays personal stuff from the business. He doesn't care." So she was like, "Oh, okay."
He won't last 15 years in jail. He's not worried.
Exactly. But ideally, if you're younger, if you're not retirement age, don't do it. Just pay it personally.
You don't want to mess around.
Yeah. So that's a big thing that can save you some money on tax. Obviously, doing your books ahead of time will give you knowledge into like how much you'll owe. Let's say it's November and you're, oh my God, like I'm showing $100,000 of profit. My client was like, I have $700,000 worth of profit. I'm like, there's no way you have that. So something is wrong. So you can identify and fix mistakes. And then you can also figure out, okay, in 6 months or 5 months from now, when the tax is due, I need to pay X. Okay, so in the next 5 months, I'll set aside enough money to not have to scramble. So this is something that's extremely, I think, useful. And then a couple of important things about the IRS safe harbor. So safe harbor are procedures that basically give you a get out of jail free card almost on certain things. Most businesses are on cash basis, which means they recognize income when it's actually received and recognize expense when it's actually paid, and so a lot of businesses try to pay their bills before the end of the year for them to count, right? According to the IRS safe harbor for cash basis taxpayers, business taxpayers, you can prepay certain things for the next year. You could prepay up to 12 months of rent, business rent. You could prepay car lease payments and computers or whatever you need to pay. You're going to pay a few weeks from the end of the year anyway, let's say. You can prepay that, and that is absolutely legit and allowed. You can also, part of safe harbor, stop billing your clients, let's say mid-December, because if you haven't sent them the bill, they can't pay you. I mean, they technically could, but they can't pay you. And so you can actually push that income a few days into the new year and then deal with it the following year, right? So that's completely legit as well. Strategy, something you can do. Now, if you've been thinking about doing improvements, qualified improvements, if you're leasing a business space, do that before the year is over. Some of those qualified improvements can be deducted fully in the year. And so if you finish them, basically the rule is placed in service. So if they are finished, placed in service before the end of the year, you're good. You can deduct it. And then finally, an important thing to keep in mind, and this is something that we do a lot with some of the clients. Let's say you want to buy a few computers or been wanting to buy a computer, right? For your business, or a few computers maybe for your staff. Don't wait until the last few days of the year, because here's the thing. Even if you place an order before the end of the year, the merchants are not allowed by law to charge you until the item ships. And so sometimes there could be a delay, like Apple delays stuff all the time. So if there is a delay and they ship it on January 2nd, guess what? You're out of luck.
You didn't get the deduction for that year.
Yep. So you just spent the money.
So you should walk into Best Buy or Costco and take it home with you.
Agreed. Yeah.
And pay for it right then and there would be the better transaction than trusting the shipping departments come Thanksgiving time and beyond.
Yeah,
exactly. When they're not their slowest season, right?
Exactly. And so
that's good tips.
Related to that, keep something in mind. A lot of businesses don't have a business credit card because sometimes it's hard to get.
Yeah.
And there is a special rule when it's a business credit card versus a personal credit card. So you have to keep that in mind. When it's a business credit card and you charge it before the end of the year, and they charge you before the end of the year, you can take a deduction when charged, even though you're paying it off next month, which is next year. When it's a personal credit card, you only get a deduction if you've paid off the balance before the end of the year. So you can charge it on December 23rd, but if you don't pay off that balance before December 31st, you're out of luck.
Wow. And if you're carrying a balance,
then you're out of luck.
Small businesses might be unable to pay off their card, right? Cash flow wise, they're not paying cash. They're putting on the card. The card might be carried for several months. So that's a good tip if you're using your personal credit cards, which a lot of the small businesses have to start out with. They're not getting a business credit card or business credit for quite a while.
Yeah. Yeah. And, when you do that, remember I mentioned no commingling kind of funds and stuff. What I recommend is if you have to use a personal card, designate one card that will be your business and no personal stuff will ever go in there.
Right.
Discipline and following the rules. And then you can have a really good chance at defending yourself in an audit. But then remember this rule about the end of the year, purchases versus payoffs of the balance. So something to keep in mind. And I think that's pretty much it for today. I think we can actually.
I'm exhausted thinking about all this stuff. Oh man, you scared me. I hope somebody out there's got a business is thinking about, maybe I'm not doing everything the way I should be. So we got a lot of great tips here. So I'm going to recap because we've been going a bit. So we started out with the Augusta rule, and that's using and renting space from yourself for 14 days or less and being able to claim an additional home use style or type of credit or deduction. So, and then Tatiana shared with us using an accountable plan, right? Yep. You tied into home office use, car leasing, phone use, things of that nature. Because again, people commingle. So, if you're using these things for more than one purpose, look, a startup business doesn't want to waste money and have two cell phones to separate, or everybody's already got their personal number. Now you're going to give them this whole separate number and a separate phone and, and pay AT&T and Verizon and whomever, Mint Mobile, all this extra money. So, these are things that if you're not in tune to, folks, you're going to step on the rake. You're going to get smacked in the face. The last piece we just touched on a little bit had to do with the personal some of the personal credit card use disadvantages versus business. So that was very eye-opening there. So those are some great tips here. We're kind of running out of time. We're about 40-minute mark here. So I appreciate you joining us today. I hope the listener, the small business owner, somebody thinking about getting into their own business, has their own business, they're not necessarily hiring the tax professional yet. You better think twice. You better get some assistance there. And look, I don't think anybody should start out launching a business opportunity without seeking counsel from a professional like you and or an attorney, a business attorney and a tax advisor to understand the proper or the best ways. And businesses are different. If I'm manufacturing, that's different than services. I'm selling insurance. I'm an agent. Like that's different than having a manufacturing facility and equipment and employees and, workers' comp to deal with. Like that's just so many other things of complexity. So people, you need, look, I have the show called Ask the Planman for a reason. It's all about being proactive and a plan. So you're going to launch a business. You need a business plan and you need to look at those things and you need to speak with bankers and you need to speak with tax people like Tatiana. So how can we get a hold of you? We're going to put it when the show, this is live, but we're going to be putting it on our YouTube channel as we always do for the podcast. So how can we get a hold of you if people want to speak with you and at least get a consult? I'm sure you'd be able to give them a couple minutes of your time for gratis to start and then advise them whether or not you can help them and tell them how it works, how it would pursue to work with you. But how can we get a hold of you?
So before I answer that question, I will tell you that you can get a cheat sheet on starting a business. I actually wrote a book specifically to help people start better. It's called Dream Bold, Start Smart. And it's a book specifically for those starting a business to get you started cheap.
I'll tell you what,
good.
Is it on Amazon? How do people get it?
Amazon, absolutely.
All right.
Yeah.
I'm going to give away the first 5 copies. Anybody that pings me, texts me, emails me, calls me at 844-PLANMAN. If you're looking to start a book, I'm going to give out 5 copies to the first 5 callers, listeners, subscribers. Hopefully somebody is listening and will pick up on that. And I'll order the book and send it to them for you, Tatiana. How's that? So
sounds awesome.
I'll boost your Amazon book sales.
Yes, that would be great. Thank you. I appreciate it. I think Amazon stopped stocking it.
We'll if somebody reaches out to me, we'll figure out how to get them the book. I'm sure you got a box sitting somewhere in the house.
Absolutely. A bunch of them. Yeah.
Before I offer 5 books, how much is a book?
24.
For me?
For you? 50%.
29. I just went up. All right. Thank you so much. I appreciate that. How about a phone number? You want anybody give a phone number? The book title we'll post later. How about for you?
Sure. A phone number, text me at 212-739-9185. 212.
That's a New York number, folks. You're dealing with New York posse right here. So, all right, Tatiana, thank you so much for being. You brought up the attorneys before going to jail. So you know what they call 1,000 attorneys that drive off a cliff and fall into the ocean?
No.
A good start. Again, that's my old joke. All my attorney clients are going to fire me now. I'm just kidding, folks. I'm just kidding. That's an old joke. I used to have the old joke books you read there in the 70s and 80s, and that was one of them. So I have all those joke books. I gave him a couple jokes today. What can I do?
Can I do one?
Yeah. Well, is it a good one? Is it dirty?
It's a
PG show. No,
not dirty.
Then never mind.
When does a joke become a dad joke?
Wait, I'm a dad. Wait a minute. When does a joke become a dad joke? I don't know.
When it becomes apparent.
There we go. All right, folks. If you need some advice, always get it right. Come ask the Planman. I hope you got a few tips out of here today, listening in live. If you're hearing the replay on our podcast, please like, share, subscribe. Tatiana, thanks for being with us. I gave some sound nuggets of advice. If you're starting a business, pick up her book. Hit me up. We'll get you a copy. First 5 people, book on us here at Ask the Planman. Till next time, thank you, Tatiana.
Thanks, Bruce.
When you need some advice,